Welcome to FARview, the podcast series of the Foundation for Auditing Research. In this podcast, we interview academics and professionals regarding the practical relevance of academic research in the field of auditing. The Foundation for Auditing Research is an autonomous institute focused on developing and disseminating scientific knowledge concerning audit quality in the Netherlands. FAR pursues these objectives by facilitating relevant and rigorous academic research through a unique collaboration between academia and audit practice.
Dear listeners, today's guest in the FARview podcast is Sebastian Kuhn from Ludwig Maximilians University in Munich. Welcome, Sebastian. It would be great if you could briefly introduce yourself first.
Sure. First of all, thanks for having me. So my name is Sebastian Kuhn. I'm a second-year PhD student at the Ludwig Maximilians University in Munich, the LMU. I'm in the Institute for Accounting and Control of Professor Christian Hofmann. And before that, I studied in Munich for a while in Australia as well. And I got my master's degree from LMU as well. Mm-hmm. So right now I work full-time on this project for the Foundation for Auditing Research. Our team consists of Professor Hofmann, the leader of our chair, my colleague, Dr. Nina Schweiger, and Dr. Jeroen van Raak from the University of Amsterdam.
Yes, I know him, yeah. So your background is mainly in accounting then?
Absolutely, yeah.
Okay. Well, I thought the best way maybe to approach this is to you split up your research project into two work packages, as you call them. One of them is kind of general understanding the relevance of internal control quality for audit quality. And the second one is how could the auditor use, the way financial analysts think about internal control quality and particularly fraud. Maybe we could first focus a bit on the first package. We already know a lot about the topic. So what do you add to this already existing knowledge with your study?
Yeah, I guess that's a fair question. So obviously, this entire field of research, the audit of internal control systems, is a very relevant topic. We've just only recently seen this here in Germany with the Wirecard case. Mm-hmm. And so we're not the first ones to realize how important it is and to study it. Mm-hmm. I think something that we realized is that a lot of the studies in this field use publicly available data. And this publicly available data is just a little bit broad, it's a little bit unspecific, and it kind of lacks the ability of the studies using it to make statements in terms of causality. So if I can just use academic language here for a second. Mm-hmm. So the idea is that internal control quality and audit quality, the two most important variables here, they're both endogenous. Mm-hmm. It means that they're determined as the result of other variables within our broader model. So, empirically speaking, any association between these two variables would be due to the variation of an exogenous variable. So, what this means for us is, but basically what we're looking at here is what is known as the audit risk model, which I guess is a pretty common idea. Mm-hmm. So the relationship between internal control quality and audit quality and, of course, audit effort. And we know in general how this is supposed to work and how it works, but we just lack knowledge of the specifics and of the drivers of this relationship and how it really works and how it's done in practice. And I think for me, this is where the Foundation for Auditing Research really comes in. Because when I said that these constructs that make the foundation for the audit risk model, they can't really be measured using public data, but FAR will provide us with the internal data from audit firms that will make this much, much easier. Mm-hmm. And one good example for this would be auditor effort, for example, which is obviously an essential part of the audit risk model, mm-hmm. and which is in most academic studies right now measured by audit fees that are being paid. And that's obviously problematic, right? Because audit fees also have a risk premium component, and there's always the possibility of negotiations and lowballing. And so drawing causal conclusions from a model using audit fees as a measure of auditor effort it's problematic.
Mm-hmm. So how are you going to do that?
So from what we've seen so far, it's going to be much easier for us to measure auditor effort because we will have the data of the hours spent by auditors or by the personnel of audit firms of different ranks on any given engagement. And that's going to be a very precise measure. And it's also going to reflect the decision made by the audit firm behind the engagement. And that is what I was talking about earlier about the exogenous variable. Because obviously the audit firm makes some kind of assessment on how much personnel and how many resources to allocate to any engagement. And we will be able to measure that very, very precisely, because we will know exactly how many hours any auditor of any given rank will have spent on the engagement.
So how do you relate that to the internal control quality then? How do you measure that?
That's also a good question. So internal control quality is, of course, always going to be a little bit more difficult to measure. But for us, the most important part is how internal control quality is assessed by the auditor. And obviously, we will have that data as well. That's probably the other really important variable for us, is how the auditor assesses internal control quality. And then we will be able to see how they actually react to their assessments, and if they later change their assessments, or if that assessment turned out to be correct in the first place.
Well, that already sounds like a daunting task to me. But
yeah, it is.
But you add a second major part. How financial analysts can be used as an information channel for auditors in assessing internal control quality. That seems, well, to me, it seems like more innovative topic in your study, apart from the method you use. So maybe you can tell a bit more about that idea. What's the idea behind this work package?
Gladly. So I guess when you first hear that, the idea that financial analysts can help auditors assess internal control quality, it's, as you say, it's a little bit more innovative and a little bit more out there. So I think to understand where we're coming from with this idea, it's important to understand two things that we're coming from. So basically, the first is that financial analysts actually care about internal controls. That is, that they have an incentive to gather information about internal control quality. And second, that they actually have information on that as well that auditors might find useful. So for the first point, there's some evidence, or quite a bit, I might say, evidence in academia that financial analysts are actually interested in internal control quality. And that's, of course, because internal control weaknesses directly affect the firm's operations. And an analyst, well, as an analyst, my job would be to assess the firm's future performance. And that's going to be much more difficult if I don't understand the internal control quality, because that means I don't really know how well I can rely on any data that's given, on any numbers that are in the balance sheet, for example. And basically, I'm going to have a much more difficult time assessing the firm's operation in the future. So as an analyst, I would try to find out as much about internal controls as I possibly can. And then the second part, which I guess is just as important, is, do analysts actually know anything about internal controls? And here the idea is, this is a little bit more indirect, I guess, this channel. So analysts are generally experts about macroeconomic factors, and they generally have some good industry expertise as well. And our idea here is that these 2 points allow analysts to assess how important it is that a firm has strong internal controls, and what the consequences of weak internal controls would be for that firm, given the current macroeconomic climate. And then basically taking these 2 ideas together, we think that analysts very likely care about internal controls, that they have incentive to care about internal controls, and that they also have some amount of private information about internal controls. And then we want to examine if this information can be extracted and then used.
But also within the audit, you of course have industry specialists. Do you think that an analyst can outperform an auditor in assessing these fraud risks for particular clients in an industry?
That's probably a very fair question as well. So the way we view it is that obviously both analysts and auditors have some very good firm and industry specific knowledge. So they're both experts here in this field. The way we view it, analysts probably care more about future developments, and auditors have a stronger focus on current and past data. And as a result, we view it as fairly plausible that the 2 sets of specialists, that they use different information sources for their assessments. And Yeah, it's not a given. It's not necessarily true, but it's something that we would like to test empirically whether analysts can actually contribute to this fraud assessment. And there's actually a really interesting paper by Hutton, Lee, and Chu, which analyzes the circumstances under which financial analysts are better at forecasting a firm's future performance compared to the firm's management itself, which is, I guess, quite the task to outperform the actual firm's management. But the authors of this paper, they find that the financial analysts have an advantage under very specific circumstances. That is when macroeconomic factors, such as the GDP growth currently, are the most important driver behind firm performance. And so what we're thinking is, if there's a possible set of circumstances where financial analysts actually outperform managers in the forecast, then it's quite reasonable that they also have the opportunity, or that it's possible that they have similar advantages compared to auditors.
So in the study, are you particularly going to look at what the potential uses for an auditor might be from the information in the analyst meeting? Or do you also test whether auditors already use this information?
Yeah, this is something that we've not necessarily been able to completely untangle yet. But I think first of all, what we do is we want to know if there is any presence of information at all in these analyst questions. And then we want to have a look at the potential use for analyst information. And I guess that's kind of the first step, what we do. And then we will investigate whether what the auditors did or could have done, if that could have been improved using this information. And that's where, again, the information, the data provided to us by FAR will be very important, because it will enable us to really put ourselves into auditors' shoes and really understand what auditors were doing at the time, what the assessment looked like, and then compare that to the information content of analyst questions. I think how auditors actually make use of earnings call information is fairly difficult for us to assess the way we are conducting our study, and I guess we will get to that soon enough. I think there's another FAR project by Mark Peacher, who's doing some very interesting research that goes more into that direction, because I think he's doing field experiments. I guess the results of that project might give some insights there, but that's not generally the direction that we will be going.
So, well, maybe you can tell a bit more about how you're going to study these questions.
Yeah, absolutely. So the basis of our study will be the transcripts of earnings calls. That is, where we will just look at the questions mostly asked by analysts. We will not really focus on the answers by managers. And then we will put the questions into relation with the internal control quality of the firm in question. That is the firm that was holding the earnings call. And then we will use the FAR data for that, of course, on internal control weaknesses and how the auditor assessed the internal control quality of that firm, and look for systematic relations in the type of questions that the analysts were asking in such earnings calls where the internal control quality of the firm later turned out to be especially high, or more interestingly, especially low.
Is it possible that maybe the analyst learns from the auditor?
Yeah, I mean, the analyst would absolutely, I guess, would absolutely love to learn from the auditors, because that is probably the type of data that analysts like access to. We have been talking about this, but I guess the information channel isn't 100% clear in that direction of how auditors and financial analysts would interact. Yeah, again, it's definitely something analysts would be interested in, because there's quite some interesting literature on the type of information that financial analysts are actively looking for. And what they really want is to understand the internal processes of a firm at the most detailed level. And that is, I guess, exactly what auditors have access to.
Do you already have some preliminary results? Well, I saw you already analyze some American data. Maybe you could tell a bit about that, and maybe what you know about the Netherlands already.
Sure. So, yeah, obviously we haven't been able to work on the FAR data yet, because that is still ongoing. We have some tentative first evidence, and I think it's all very promising what we're seeing. it looks like, or we have evidence that the analyst questions actually do provide information, and that this information has predictive power in predicting internal control quality, which is incremental compared to just financial statement data. And we view this as a very encouraging sign that these earnings calls actually have non-trivial information content.
Mm-hmm.
And of course, we'll hope to dig deeper into that direction and at some point, formulate some clearer statements in that.
Okay. Well, maybe it's nice to talk a bit about the products that will result from the study. You're talking about developing a dictionary that auditors could use to detect fraud. Well, that sounds very interesting. Maybe you can tell a bit more about how that is going to work, how auditors can use that, maybe.
Sure. So in general, the idea that we're following here about the dictionary is to find a list of words or sets of words, types of questions, which indicate a higher risk of internal control weaknesses. For example, something that we've had in mind here as there's a paper by David Lauker and Anastasia Zakliukina, who do something very similar by going through CEO and CFO statements and labeling them as truthful or deceptive, and then developing, again, classes of words, just general types of statements, these kinds of clusters that are linked to deception in these executive statements. And that is the general direction which we want to take our project into as well. So we want to find similarities in questions asked by financial analysts in those calls where the firm later turned out to have weak internal controls compared to the calls where that wasn't the case. And I guess one thing that makes our setting a little bit different, a little bit more challenging, but also very interesting, is that we don't expect to find very direct results. So I think the analyst-manager interaction is a very interesting one because we don't expect it to be that easy, right? So we don't expect analysts to actually go into an earnings call and ask the manager, are there any internal control weakness that you haven't told us about? Because obviously the manager isn't going to say yes to that. And as a financial analyst, my job is also not to offend the manager and not to say anything that sounds like an attack. And so there's this level of relationship building by the analyst that also plays a role here. And the analyst in general has to balance these different incentives because they want to increase their information advantage. They want to generate new information through the call, but they also don't want to make it too clear that they might have some private knowledge. So what we believe we might be finding here for this dictionary is that it's not just types of questions and subjects that the analysts are addressing, but also different ways of how questions are asked. That is, different ways of formulating a question, just different question words to use, and maybe the tone of the question might be different as well. So we believe that it's the best if we address both what the analysts are asking and how they're asking it.
So it's more than like an instruction about what questions to ask, or is it a tool to analyze the contents of the meetings?
I would say the latter.
Okay.
Yeah, definitely.
So you could use, will it be an expert system then, or will this be automated, or?
Well, I guess it's a little bit too early to talk about how we would actually end up implementing it, but I could see that working. I could see that working either way.
Well, thank you very much for your time.
Thanks for having me.
I hope to see you live somewhere in the near future. Okay.
See you.
Bye-bye.
Bye. See you.